Welcome to The Explainer. Today, we're going to break down one of the most powerful tools in all of finance. And by the end of this, I promise, you'll be able to read a company's financial X-ray like you've been doing it for years.
So let's just jump right in with a fundamental question. Whether you're an investor, a manager, or hey, maybe you're thinking about working for a company, how do you actually get a clear, honest picture of its financial health? There's one document designed to do exactly that.
And that document is the balance sheet. Now, this is way more than just a boring list of numbers. Think of it like a perfectly clear photograph. It captures everything a company owns, everything it owes, and what's left over for the owners, all frozen in a single specific moment. It's the absolute foundation for understanding where a company stands.
We're going to tackle this just like a consultant would, breaking it down into 5 logical pieces. First, we'll hit the core logic. That's the accounting equation. Then we'll deconstruct assets, liabilities, and equity piece by piece. And finally, we'll pull it all together and see how you can use this for some really sharp strategic analysis. So let's get into it.
Okay, first up, the accounting equation. Seriously, this is the bedrock. It's the simple, unbreakable rule that governs, well, pretty much all of finance.
And here it is. Assets equal liabilities plus shareholder equity. You know, it's actually super intuitive when you stop and think about it. Everything a company owns, all its assets, had to come from somewhere, right? And there are really only 2 ways to pay for things. Either the company borrowed money to get it, which creates a liability, or it used money from its owners, which is the shareholder equity part. Simple as that. What you have is funded by what you owe and what you own.
Let's make this crystal clear with an analogy you already know. Think about buying a house. The house itself, that's your asset. That big loan you got from the bank, the mortgage, that's your liability. It's what you owe. And that down payment you scrape together from your own savings, that's your equity. See how it works? Your asset, the house, is perfectly balanced by what you owe plus what you put in. This exact same logic applies to any company on the planet, no matter how big.
All right, we've got the equation down. So now let's start taking it apart, starting with the first piece, assets. And we're going to use a classic consultant's tool here called MEAS. It just means breaking things down in a way that's logical and complete, so we don't miss anything.
So at the highest level, you can slice assets into 2 clean categories. On one hand, you've got current assets. These are things that are either cash already or can be turned into cash pretty quickly. We're talking within a year. And they're always listed by how liquid they are. On the other hand, you have non-current assets. These are the big, long-term things, the foundation of the company that aren't meant to be sold off quickly.
So if we drill down into current assets, what you're really seeing is a company's short-term financial firepower. It always starts with the most liquid thing there is, cash, and things that are basically cash, like treasury bills. Next up, you've got marketable securities, which can be sold on the stock market super easily. Then comes accounts receivable, that's money your customers owe you. After that is inventory, which, still needs to be sold. And finally, you have things like prepaid expenses, like paying your rent up front.
Now for the other side of the coin, the non-current assets. This is the stuff that powers a company's long-term vision. We're talking long-term investments and, of course, the physical backbone of the company. That's property, plant, and equipment, or PPE. Then you get to the really interesting stuff, intangible assets. These are things you can't touch, like patents, trademarks, and something called goodwill. This is a huge deal because the balance sheet can sometimes dramatically understate a company's true value here. Think about how valuable a world-famous brand is. Okay, so we've seen what a company owns. Now let's get back to how it's all funded, and we'll start with liabilities. In other words, what the company owes to others. And just like with assets, we can make a really clean break here based on time. You have current liabilities. These are the bills and debts that are due within the next year, the immediate stuff. Then you have long-term liabilities, which are due more than a year from now. These usually represent big, strategic financial decisions.
Drilling down into current liabilities, you really see the operational pulse of the company. Accounts payable, that's money you owe your suppliers for stuff they've already given you. Wages payable, pretty straightforward, what you owe your employees. You'll also see the current portion of long-term debt. That's the slice of a big loan that you have to pay back this year. And then there's customer prepayments. When a customer pays you upfront for something you haven't delivered yet, that's cash in the door, but it's technically a liability until you make good on your promise.
And now for the big picture borrowing. Long-term debt, like corporate bonds or huge bank loans, is what companies use to fund massive projects, like building a new factory. Then there are things like pension liabilities. Those are long-term promises made to employees for their retirement. And deferred tax liabilities, which are basically taxes the company knows it will have to pay, just not right now. This isn't about keeping the lights on day to day. This is about financing the future.
So we've covered what's owned, the assets, and we've covered what's owed, the liabilities. So the next logical question is, what's left over? That value, that residual amount after every single debt is settled, well, that belongs to the owners. And that is shareholder equity.
So the official definition is that shareholder equity is the money that belongs to the owners. But you'll also hear it called net assets or book value. Why? Because it's literally the company's total assets minus its total liabilities. It's the final piece of the puzzle that makes our whole equation balance out perfectly.
Now, this owner's stake is made up of a few different things. You have the initial money that came from selling stock, but for any company that's been around for a while, the real engine of growth here is retained earnings. This is huge. It's the grand total of all the profits the company has ever made and decided to plow right back into the business instead of paying it out to shareholders. Every single dollar here represents a strategic choice to reinvest and grow.
So there you have it. We've completely deconstructed the balance sheet into its core parts. We get assets, we get liabilities, and we get equity. Now for the fun part. Let's put it all together and see how this thing becomes an absolutely essential tool for strategy.
Let's make this real with an example from Apple. Take a look at 2024. You see total assets of about $365 billion. Okay, now look at the other side of the equation. You've got about $302 billion in liabilities, plus about $63 billion in equity. You add those two together, and what do you get? It balances perfectly to that $365 billion asset number. It has to. The equation always holds.
So why does all this matter? What can you actually do with this information? Well, a few critical things. First, you use it to figure out risk. Does the company have way too much debt? Can it actually pay its upcoming bills? Second, you use it to get money. No lender or serious investor will talk to you without it. Third, you use it to measure performance, calculating all sorts of key financial ratios. And fourth, you even use it to attract top talent, because a strong balance sheet signals a stable, secure place to work.
But, and this is important, a truly skilled analyst knows that the balance sheet isn't the whole story. You have to understand its limitations. Remember, it's just a snapshot in time. To see the actual trends, you need to compare several of them over time. Also, different companies can use different accounting methods, and some numbers are just professional estimates. And like we talked about, some of the most valuable assets, like a company's brand reputation, might not be fully captured on paper.
You know, this quote from Investopedia just nails it. From the CEO to the investor to the analyst to the government regulator, the balance sheet is the common language everyone speaks to understand where a business stands financially. It is absolutely essential.
So we've established that one balance sheet is a static photo, but the real magic, the real insight, comes when you lay that photo next to the one from last quarter and the quarter before that. You turn those snapshots into a movie, and that movie tells you the real story of a company's journey. So the final question I'll leave you with is this. Now that you know what's in the snapshot, what's the first trend you're going to look for?